On this week's episode of the Crushing Debt Podcast, the secret to deferring payment of taxes. So, welcome back. My name is Sean Yesner, owner and founder of Yesner Law, and I actually am solo this week. So, we miss you, George, and we'll see you back here next week. I did say at the end of the last episode, or towards the end of the last episode, we talked about that I thought I might be hacked by somebody impersonating Social Security, and last week's episode was all about how to tell if you're being hacked or scammed or something like that. Well, the ending to that story is I did call over to Social Security. It was a legitimate letter. They were trying to pay me benefits for my wife who had passed, and so everything worked out in terms of it was not a scam. It was a legitimate issue. I ended up getting paid the money just a few days ago, and so. But there were enough red flags there, and so hopefully if you haven't listened to last week's episode, go back and listen to it, and it's all about how to avoid scams and what kind of red flags that we discovered and what you might want to do. But I do want to jump right into this week's episode. So although I am hosting solo, I am not on the podcast solo. I do have a guest with us this week, and he is the 1031 investor. In fact, that's where you can find him on his website, the 1031 investor. And his name is Dave Foster. And so welcome, Dave.
Thank you, Sean. It's great to be here with you today.
So, I have your bio here from the website. And again, if somebody wants to contact you, it's Dave at the1031investor.com, and I'll post the links to your email, the website. I'll post all that in the notes here. But in going through the About Us section, there's a lot of interesting stuff in here. So rather than trying to read it as your bio, I thought that's how we would get into it. So, the first thing that really was of interest to me is how you got into 1031 investing, because it wasn't how you first started out your real estate career, right?
No, that's exactly right. I guess the way I got in to 1031 exchanges was through a big mistake. I screwed up bad. And as a consequence of that, you can either live with your mistakes or you can learn how to not repeat them. And that's what we chose to do. So, way back in the mid 90s, when my wife and I decided that we wanted to restructure our lives, kind of like an early fire movement sort of thing. How do we get off the corporate train? And we decided to become real estate investors. So, ready, fire, aim, Dave bought a duplex, fixed it up, rented it out, and sold it, and made what I thought was a lot of money till my accountant that year. And I am an accountant, but I never trust myself to do my own taxes. My accountant said, "Well, you made $30,000 less than you think because you're going to write a check to the government." And it was right then that I realized that I had a silent partner named Uncle Sam, and also that this was going to put our get out of Dodge plan in severe jeopardy for a number of years. So, in reading through the statutes and trying to find ways, I discovered the 1031 exchange, which had just undergone a facelift and was now available to regular investors. And from that day, we started using it. We started doing it for others, and we've never looked back.
So let's talk a little bit about the 1031 exchange. And I want to kind of get into this as well. But really, what we're talking about, to back up for a minute, is you can defer the gain on property. So in other words, where you had to pay, and I think your bio says, or the About Us page, about 40% of the gain of that sale was paid in taxes. And then I think later on when you added in, that was both federal and state tax. Is that right?
Right. So, anytime you sell real estate, every legislative body in the world wants a part of your money, right? And so there's federal tax, there's state tax, there's this lovely little trap that the IRS plays called depreciation recapture, where they let you pretend that your real estate loses money every year so that you can get a tax write off. Now that seems kind of nice and benign, doesn't it?
Right.
But here's the nasty gram. When you sell the real estate, the IRS says you got to pay that back. So they give you the gift and then they take it back. The 1031 exchange allows you to sell investment real estate and then buy new investment real estate. And I'm going to add a word for you here. In allows you to indefinitely defer paying the tax, federal and state on the gain, and depreciation recapture. So it's really no small thing. I still have sleepless nights over that first deal because if I would have been able to keep that $30,000 and if I would have made 10% a year for the last 30 years on that $30,000, I would have over $1 million more in my bank account. Instead, it went into the black hole of Washington, and I don't know, I got a bridge or a highway or something out of it, but not nearly what I would have preferred.
Well, and I understand the indefinite deferment, but I mean, at some point, unless maybe within your estate plan, it's got to be covered because I think in estate planning, the tax basis of something will increase to the date of death to when the heirs inherit it. But theoretically, if one day you decide, okay, we're going to sell off everything, we're going to live off of that money, and we're not going to buy anything else. We're not going to replace the real estate that we sold with a new piece of real estate. At that point in time, without some kind of estate planning, the taxes would eventually be owed, right?
If you simply sold all of your real estate and started to live off of that money, yeah, you'd pay the tax. But what's the likelihood that someone is simply going to sell their real estate, put the money into a bank, and then start drawing it down? We go into different types of investments, don't we?
Right.
And this is the beauty of what the 1031 exchange allows us to do. And it's where I'm living and where I'm going. So the best way to explain this, Sean, would be like using what I call the 4 Ds of 1031 investing. And the first D is to, well, start, defer. Because when you first defer tax through a 1031 exchange, you get to use the profits to start to benefit yourself. So just like my sale 30 years ago, I started the compounding effect with my first 1031 exchange. And as long as I own that property, or as long as I do another 1031 exchange, I never have to pay that back. So it continues to compound for me. So that's the first D, is that it allows you to get the compounding effect of the unpaid tax. The second D starts to speak to the things that you're talking about, which is that we all go through ebbs and flows in a real estate cycle, don't we? The 1031 exchange allows you to react to whatever the market is telling you. So there's never as clear an option as, oh my gosh, I've got to sell everything off or I've got to stay invested. Because the 1031 exchange allows you to sell your real estate wherever it is and purchase anywhere else in the United States. It allows you to sell any type of real estate and purchase any other type of investment real estate. So, whatever the market is telling you, is it time to get out of the high appreciation markets in Menlo Park and San Jose and go buy dusty, cheap lots in Boston next door to a guy named Elon? Well, then you can react to that and keep the tax deferred. You can go from low cash flow to high cash flow by moving into different markets and different types of single family, multifamily, and whatever the market's telling you. And that's the second D. So the first D was defer, the second D was defer. What do you think the third D is?
I'm going to guess defer.
Bingo! Just like you can react to whatever the market is telling you, the 1031 exchange can be used to react and support wherever you're at in your personal life cycle. You know, I'm not the same investor today that I was 10 years ago. and I'm not the same investor that I will be 10 years from now. We change and our needs change. But the 1031 exchange allows you to accommodate that. Are you in growth mode? You can sell one property and buy multiple properties. Are you starting to get tired and wanting to shrink your portfolio? You can sell several properties and 1031 exchange into fewer. You can move from high management single family rentals to triple net commercial properties where you don't have management responsibilities. All of those things can accommodate. What if you're in a mode where you're starting to have children and it's time to start building memories? 1031 exchange from rental properties, go buy a vacation rental where you can still generate the income, but you're also going to be able to spend some time there yourself and build memories. And along with that comes retirement, because we're not quite where you were talking about yet. As retirement starts to come, typically there's a couple of things that happen. Number one, we want to retire in a nice place. Number two, we want to become more passive because it's time to enjoy the grandkids, right? So, ahead of retirement, if I'm in Cincinnati and I want to retire in Sarasota, I may start to move my portfolio using 1031 exchanges into Sarasota so that when I retire, there's my portfolio waiting for me. But it gets even better because when I sell my primary residence in Cincinnati, because it's my primary residence, my wife and I would get the first $500,000 of profit tax free.
Right.
Now, I could go buy another house with that, but I could also convert one of my tax deferred rental properties. Maybe it's the nicest one on Siesta Key. And I convert that into my next retirement primary residence. As long as I own it, there's no tax due. So I can go all the way through to retirement, right? Without paying any tax. And here's where we throw gasoline on the fire. Anytime I sell that property, if I have owned it for 5 years, if I've lived in it for at least 2 years, then I get to prorate the gain and take the gain that's allocated towards the number of years I lived in it tax free.
Oh, wow.
So I can actually convert a bunch of those tax deferred dollars into tax free dollars. So far, I've not given you any reason to just sell and pay the tax.
Right.
Have I?
No. And I didn't even realize that. So there are ways to convert what would otherwise be the deferred gain into an exempt or a non-taxable gain. I didn't even realize that. And like you, my background's in accounting, but I am not a tax attorney. I am not a CPA. I know enough about 1031 exchanges to be dangerous. I know enough about 1031 exchanges to represent buyers and sellers that are going through 1031s. But I'm not a tax person. I'm not a qualified intermediary, which I also want to talk to you about. I don't quite know I know there are certain rules that I don't know off the top of my head in terms of how long you have to identify the replacement property, how long you have to close on the replacement property. I know that there are rules like I think you can go from real estate to real estate. So like you said, I could go from a commercial building and buy vacant land with the profits, I think. But I don't think I can go from a commercial building and buy a business and defer the gain because I'm going from land to business. In other words, I've got to go from property to property, or I've got to go from business to business. I can't mix and mingle, right?
Until 2018, you could sell personal assets, heavy equipment, airplanes, et cetera, and do 1031 exchanges. Excuse me. Since that time now, it is restricted only to real estate, investment real estate. So you can sell any type and buy any type, but it does have to be investment real estate.
Oh, so I can't do a 1031 on I can't do a 1031 on, say, if I were to sell one business and buy another business.
Only on the real estate component.
Okay.
that's involved in those businesses. That's correct.
Or what if I owned an airplane and I sold one airplane and I bought a new airplane?
You are out of luck thanks to former President Trump, who was
Okay.
actually the one who changed that law. Interestingly enough, he never came out and said this, but this is why he did this. We used to be able to exchange airplanes for airplanes, and that was great for the airlines we worked with. But instead, in exchange for bonus depreciation, he gave up the 1031 on businesses and equipment. So, what did he get to do with that nice 747? Not Air Force One, the one that he owns. He got to depreciate it off 100% in 2019. So, it was a great gift for himself, but now we can no longer exchange equipment.
Oh wow. Okay, so you could depreciate. Well, wouldn't you get the depreciation recapture when you sell it?
Well, yeah, he will. And I don't quite know how he's going to deal with that.
Yeah.
We'll see.
We'll see. We'll see. He's got some other stuff he's got to worry about. Without getting
Exactly.
political, I don't want to get political at all,
No,
but
no, no.
but he's
No,
got some
well,
other
but
stuff he's
interestingly
dealing with.
enough, though, that really does demonstrate something. People say, this is a loophole. Isn't Congress going to change this and everything? Every president that I've been under, red and blue, for 25 years, has talked about eliminating 1031 exchanges. So it's seen as low hanging fruit, right? It's the rich people that are doing this and that kind of thing. But really, there's a couple of facts that are just amazing. The first one is that the average price, sales price of a 1031 exchange property, $400,000.
Okay.
These are not $50 million Hilton hotels.
Right.
This is Main Street who are doing these. And so when Congress sees that, they go, wait a minute, we're messing with our people, the ones we're trying to benefit. The other thing, though, that comes into play, and it's, the Biden administration is asked to eliminate 1031 every year. And every year it gets voted down by both House seats of Congress because the studies are out there that show that for the amount of money you would get in capital gains tax from the 1031 exchanges, you lose the ordinary income tax, which is more, on 2 real estate commissions, 2 title company transactions, 2 appraisers, 2 painters, 2 handymen, 2 real estate attorneys.
Right.
And the list goes on and on and on to where they actually show that eliminating 1031 exchanges loses several $billions for the federal government. And when they see that, they stop trying to get rid of it.
Yeah, they're not.
It's an incentivizer. 1031 exchanges make for an active and vibrant, healthy real estate economy. And U.S. is driving on that, isn't it? Think about what a percentage of our GDP is real estate.
Oh yeah. And I've said for a while, especially being on the front lines, doing a lot of bankruptcies. I've got, as soon as we're done recording today, I've got someone coming in to file a bankruptcy petition, and I've said that I don't think we're going to have the same crash that we had 2008, 2009, the Great Recession. I don't think we're going to have that big a crash. I think we're going to have a correction, but I think, interestingly, I believe that it's going to be real estate that tends to pull us out of it, where the recession, I think, was real estate caused, or mortgage lending caused. But I think real estate might pull us out of this one if it's going to, because it's still appreciating in value at a relatively reasonable rate. It's still, people still want to buy and own real estate. I think I saw something the other day that millennials, who were the largest group that were not buying real estate, are now starting to buy real estate. And so it'll be interesting. I know we've got an election coming up. And again, I don't really want to get political. I've got enough criticism, whether you're Republican or Democrat. There's enough criticism to go around. But yeah, no, I do think real estate is going to be a bigger help. So I did want to talk a little bit about the rules, because one of the questions I asked you as we were going back and forth to try to schedule recording today's episode, You are a qualified intermediary, right?
That is correct.
Okay, so
That's actually what I do for my 9 to 5.
okay. So for those that don't know, what that means is you, as a real estate owner, you can't sell a piece of property and then say, I think I want to do a 1031. And you can't sell a piece of property and go, oh my gosh, look at the gain. Hey, title company, hang on to it because I think I might want to do a 1031. You do have to identify, you do have to do some due diligence. There has to be someone like you called a qualified intermediary that, in essence, manages the funds, manages the transaction. You are the straw man between seller and the seller on one transaction who becomes the buyer on another one, right?
Yeah, the IRS will not let you DIY a 1031 exchange. You have to use the services of an otherwise unrelated third party called the qualified intermediary. So we can have no other role other than administering the 1031 exchange. So, but your accountant cannot do your 1031s, your realtor cannot, anybody who's related to you cannot perform your 1031 exchange. And our job is strictly to monitor, provide the documents necessary for the closing of the sale. We have to hold custody to your proceeds. The IRS will not let you take actual or constructive receipt of the money in between your sale and your purchase. And then we have to document the transaction at the closing of your purchase. And that's what the 1031 exchange does. And then that documentation is what's used by your accountant to report the 1031 exchange on your tax return.
Okay, and yeah, and I know there are also certain rules related to how soon you have to identify, and I think that might be a word under the tax code. You know, how long do you have to identify the property you're going to replace the property with? How long do you have to close on it? There are certain time rules and time restraints there, correct?
Yeah, that's exactly right. And, as good as the 1031 sounds, right? It's like almost too good to be true. This is where the IRS puts the other shoe down. And you start to realize that although they have to let you do it, they're not going to make it easy. And they're going to make sure that they've got it heavily monitored. You only have 45 days from the date of your closing of your sale to identify your potential replacement property. Doesn't mean it has to be under contract. It's really simply a written identification. But after day 45, you cannot change that list anymore. And you're stuck with what's on it. So the first 45 days are pretty critical in terms of getting that new property located. And I usually recommend try to get it under contract. You have a total of 180 days to complete the entire process, which doesn't sound too awful bad. Unless you're buying new construction and the builder tells you, I promise it's going to be done in 180 days, but they forgot that March, April, and May don't have 45 days each, as so many builders think. And if you go past day 45, don't identify. If you go past day 180 and don't close, your exchange dies. And the IRS is happy to take that tax dollars from you.
Yeah, it was funny. I got into an argument with a bank years and years and years ago. I was representing a client that had sold property. They were working with a qualified intermediary, and they were buying. They had sold a business, I think, in New York, a real estate related. The business owned real estate in New York, so they sold the real estate in New York, and they were using the proceeds of that sale to buy land in Florida. And each parcel of land that they were buying in Florida had some kind of franchise on it. One had like a KFC on it, one had like a Taco Bell on it, whatever. And the problem was we could get all three closings done within the 180-day deadline, but one happened first, and then another happened like 10 days after that, and then another one happened like 15 days after that, something like that. And so we did the first closing, qualified intermediary, sent out all the money, everything was fine. We did the second closing, qualified intermediary, sent out all the money, everything was fine. We got to the third closing, and the bank then suddenly took notice and went, wait a minute, there was more money in the qualified intermediary account than the bank wanted the buyer to bring to closing. So the bank said, buyer, you need to bring whatever it was, 200 grand to closing, and there was 250 in the qualified intermediaries account. And so I got into this huge argument with the bank, and I forget what the numbers were, but I got into this huge argument with the bank because they were like, well, we'll just have the buyer bring the 200 to closing. I said, then you're going to make the buyer pay taxes on, if I'm right, the 50 grand.
Yeah,
You know,
that's
just
exactly
that
right.
piece that was not used in the 1031. And of course, my client objected, and everybody started, and we ended up getting the bank. It was we had to force the bank to loan us less money so that we could bring more money to the closing to use up all the 1031 money. I mean, they even said, well, why don't we just loan you the money and then you can take the extra 50 grand and pay down the mortgage immediately after closing. I said, well, that's great, but it's not going to be 50 grand that's used to pay down the mortgage. It's going to be 50 grand minus the tax on 50 grand that's used to pay down the bank. Well, we don't want that. I said, well, bank, you're either going to cost your client a bunch of tax money and they're going to be pissed at you forever, or lower your loan amount. And I had to basically twist their arm to do it. And it was amazing to me. These are complicated commercial, or complex, well-educated commercial bankers that didn't understand the 1031 process.
Yeah, there's a reason for that, though. It's understandable when you look at the ebbs and flows in our country over the last century. So Section 1031's been around since 1920. It's not new, but originally it was used primarily for farmers because we were trying to grow our agribusiness industry. And everybody was sitting on 160 acres that they had homesteaded. And if a farmer wanted to sell his farm and go buy a bigger one, they couldn't do it because just like you were talking about, because of the tax they would have to pay in between. So and that kept entry level farmers from buying their first small farm. So that was why it was instituted originally. And it went along like that for a bunch of years. And then finally there was a huge court case, Starker versus the commissioner. You may have heard these things called Starker exchanges.
Yeah.
That's exactly what they're named after. Starker exchange, that was settled, and the IRS lost. How often does that happen?
Yeah, no.
And so now we were able to do 1031 exchanges, but this was only encoded in like 1996. So it's a century old law that got vastly changed in 96. And think about what happened in between 96 and today. 1031s started out the first year recorded 70,000 of them. By 2005, there were 600,000 exchanges being done each year. But what happened in 2008?
Yeah, the market crashed.
A big crash. All of those bankers who were familiar with 1031s went out, they lost their jobs. Well, actually, the bankers didn't. The banks did well. That's true.
Right.
All the realtors who were working with 1031 clients
Right.
went out of the business. All of our investors who were caught in that went out of business. And the biggest buying demographic you just mentioned now in real estate now, at the time of that crash, they were in middle school. So we lost every bit of the campfire knowledge about 1031 exchanges. So since 2010, it's had to rebuild. So that's why people don't know about it. Lenders don't understand it. Banks don't get it. We're having to slowly, and just like you said, and you're absolutely right. You and I both, in my undergraduate accounting degree, 1031 was one half of one class period.
Right.
Come on, that's nothing. So we've had to rebuild that knowledge. Now, the nice thing is that it's out there, it's being used, and hopefully there's people like you and I that are spreading the word.
Yeah, exactly. And it kind of reminds me, we keep throwing around the term 1031. It's based on IRS code section 1031. That's why it's called a 1031. I've got a kind of a funny story. People, we talk about shorthand and we talk about, jargon in terms of, we say 1031 exchange. We know it's based on 1031 of the tax code. Other people may not. It's a long story. I told it way early in the history of the podcast here, but one of the bankruptcy code sections is 341. And the same thing has developed. Attorneys have said, oh, the 341 meeting, the 341 meeting. It's basically the meeting of creditors. And I had a client once, their 341 meeting was at 2 o'clock, and they showed up late for their meeting. And when I said, why'd you show up late? They said, well, it's the 341. They showed up at 341 in the afternoon. And so I've always been careful from that point on about jargon and so it's section 1031 under the Internal Revenue Code is the section that allows all of these exchanges. But again, if you have, and part of the reason you mentioned it earlier, but part of the reason is the tax code already builds in certain tax deferments, tax exemptions, tax exclusions for selling a residential, a homestead, a primary residence property. So this really is only useful in terms of investment property, even if it's a residential property, a single family home that you rent out to somebody and it's not your primary residence. You can still do a 1031. You can do a 1031 exchange on commercial property, vacant land, all that stuff, right?
The IRS wants you, strangely enough, to do 1031 exchanges. I know I joke about them having to do it grudgingly, but they want that. That's why it's in the code.
Right.
Because if you're taking that deferred tax, you're buying more real estate with it. When you buy more real estate, someone else is selling more real estate. And real estate transactions, by and large, take dollars out of the circulation. They make money work twice as hard. And they're actually an inflation fighter because paper appreciation doesn't impact us nearly so much as when the government's printing dollars, does it?
Right.
So all of these things add value to the real estate economy and our economy in general. So the IRS truly does want you to do it. They just have to grumble because that's who they are.
Right. Okay. Well, again, if you want to contact Dave, it's Dave at the1031investor.com, or the website is the1031investor.com. Thank you for being a guest on this week's show.
Love being here. Thank you.
Is there anything maybe that we didn't cover? Anything you want to add here at the end?
Well, I think the last thing, just to reemphasize, remember you can defer. And then, like you said, when you die, that's the fourth D. When you die, your heirs are going to get that step up in basis. So all of the tax you've deferred over your lifetime disappears. Right. You don't pay it. Your estate doesn't pay it. Your heirs don't pay it. So in my book, the 1031 exchange is the greatest way to build wealth throughout your lifetime and then pass it on to the next generation.
Yeah, that's awesome. That's awesome. Thank you. I appreciate you being a guest on this week's show. George, we will see you in next week's episode. I do want to give a shout out real quick to our sponsor, Sam Cohen. He owns Attorneys First Insurance. Those of you that have been listening for at least 1 week or more will know that Sam does errors and omissions insurance for attorneys and title companies all over the country. You can contact him, Sam, at attorneysfirst.com. If you are an attorney or know an attorney or own a title company, you can go to Sam for your malpractice coverage, basically. Also, if you want to support us, if you want to help me and George buy all these investment properties that we're going to do 1031s on, you can go to the Patreon page, patreon.com/crushingdebt. I am kidding. All the money we get through Patreon goes back into the Crushing Debt podcast. And I think that will do it. We've got some exciting news coming for next week's episode. You'll have to tune in next week to hear that. Otherwise, I think that'll put an end to this week's episode. Again, thank you, Dave, for being a guest on the show. And like we say at the end of every episode, we hope that you have more money at the end of the month rather than month at the end of the money. And we will talk to you in next week's episode of the Crushing Debt Podcast.